Hey, puppy trades. I wanted to do a video analysis update of the stock market real quick. Can you believe it? Somebody actually asked me to make this video. Oh man, I bought more puts than the biggest bear on FinTwit when someone asked me to make this video. I said, "Oh man, we're getting frothy." Obviously, I'm kidding, but I do buy puts as part of my risk management system that I've detailed a lot. I've only made 2 changes to it since the last time I updated this. And so I posted about that recently. I'm not going to get into it for this video because I think this video could actually be short. We'll see. Normally when I say it actually will be short in the beginning, the people watching this see the video is like 45 minutes. But anyway, that's probably because I go into diatribes like this one. Here is SPY. I think it's a big wave 1 and a wave 2, but made this video for the dopamine bulls because right now we might actually be getting to a place in the market where looking at shorter, I didn't mean the dopamine bulls, I mean the dopamine everyone, the dopamine people who like their whole life is getting entertainment from, you know, the next 2 to 3 days, the next 2 to 3 weeks of price action. That's, you know, where all the money is made, selling discords and selling subscription services and selling financial media articles and selling options. Interestingly, but anyway, we might actually be at a point in the market where looking at some of these daily counts is very useful. So the bulls are going to say for a lot of these, and we'll have a few more examples, that this is a wave 1 and a wave 2. If we look at other parts of the market like the Qs, like Nvidia, like, you know, that's not really too hard to find. There's a lot of stocks very correlated with SPY that have already broken this high, suggesting it's within a wave 3 from the low. Now, what are the bears going to say? Well, the bears are going to say that this ABC correction is still not complete, which Conagra brands, TJX, and Caterpillar, I can't believe I forgot Caterpillar, and a few others, they've, you know, in other sectors of the market have already broken above this high. And, you know, does that matter to classical traders? No, but to Elliott wave theorists, that does matter, because if I'm a bear and I'm calling for this correction to not be complete, and I'm saying this is wave A, you know, this is wave B, and so we're looking for a wave C lower. Well, that argument worked for a really long time. In my opinion, it stopped working when In-Phase Energy and First Solar exploded. But to be a little more fair, that argument stopped working when we started seeing consumer stocks, industrial stocks really get up and break this high. So I can't tell my broker, I go all in, out of the money SPY calls on margin, that Caterpillar is already up here. I don't think Ally Invest cares about that, but they would hopefully care about the straddles that I have, the puts I can exercise, the covered call ETFs that are going to keep giving me income. But anyway, the bulls are going to say that's wave 1 and wave 2. So it's stupidly tight. But from a real short-term perspective, you know, if I'm being honest, the bulls are going to say above 374. We're within a wave 3, not just on a weekly chart, but on a daily chart. And of course, the much wider level, which I think is still quite useful since we're right at 400, is 348 for that long-term invalidation to say this is a large wave 2 correction that's ended. The length of wave 1 placed at the wave 2 low in the very big picture can take SPY up towards 600. I know that sounds crazy, but even 500 is just a marginal new high for an all-time high. I don't think I'd be the only one calling for 600. I think there'd be a lot of people calling for, 700 and 800 by the time we got to 600. Anyway, here is Nvidia. It's another one where if we zoom in on the daily chart, it's already kind of said, hey, that was wave 1, that was wave 2, we're within a wave 3. So I'm not the daily person. I have lots of ETFs. My biggest allocation by far are covered call ETFs that sell 1 month at the money call options on the indices. So I'm not, Mr. Go get the dopamine rush, but what the bulls are going to say is that's a wave one and a wave two for Nvidia, and it's kind of exploded above this wave one high. It wouldn't make too much sense to bet against SPY breaking above this marginal new high, or breaking above this wave one high. Sorry, not the marginal new high. It wouldn't make sense to say or to bet that SPY isn't going to break this wave one high when we've seen more and more names in the tech sector that have broken this wave one high. Doesn't guarantee anything, but it is looking like for Nvidia that this is a large. Did they just mess up my chart? No, they didn't. Okay, that this is a large wave one subdivided into 1, 2, 3, 4, 5 waves. We ended that wave two right between the 61.8 and 78.6% retracement of this rally from the 2018 low. And from this low, we formed another wave one and another wave two. So we're within wave three of wave three. The bare minimum expectation is that Nvidia could go all the way up above 346. So in this video, it's going to be important to distinguish kind of the long-term invalidation for a lot of these. The long-term invalidation for most of these is going to be that October low, where the bulls are saying a wave one and a wave two is formed from it. So there's a big wave three that's beginning for a lot of tech stocks, especially the ones that have already broken this wave one high. A tighter stop could be this wave two low as well. I have lots of straddles on the Metaverse ETF METV, whose biggest holding is Nvidia. So that's kind of my plan there. Here is Amazon. I wanted to get into, I should probably just talk about Amazon anyway. So this is a large wave one. It's subdivided into 1, 2, 3, 4, 5 waves. This is an ABC correction right at the 78.6% retracement. They're going to say this is a meme line, but it's really just the length of wave one placed at the wave two low, giving a minimum wave three target of 204 for Amazon. Now, in the bigger picture, let's say a while from now, Amazon did go explode and make a big wave three, and it hit 204 on the dot. Would it be crash time? No. From an Elliott wave perspective, that would be the minimum wave three target. We'd see a shallow wave four correction and a wave five higher. So this is really going to sound crazy. I get it. I think above 81, this kind of small degree wave two low, above 81, bulls aren't just looking for Amazon to go to 200. They're looking for that to be the minimum wave three target before a shallow wave four and a wave five higher. If wave four retests the wave one high and wave five is the length of wave one placed at the wave four low, Amazon could be going to 300 in the big picture. Now that's in the big picture, but it kind of reminds me of Disney. And Disney and Amazon, they're not correlated. I'm just saying it's this kind of a similar thing where we've got this kind of crazy blue chip stock. I mean, they're just objectively blue chip stocks by the definition of the word, where when if Disney and Amazon are all-time highs, what's Finchwit gonna say? They're gonna say, duh, right? No shit, Sherlock. It's Disney, it's Amazon, they're, monopoly, but that all doesn't really sound too nice at the 78.6% retracement. For Disney, the bulls are gonna say that large wave two invalidation hasn't broken yet. It was supposed to break, it didn't. So until 79.07 goes, that's wave one and wave two. Amazon's wave one and wave two. Starbucks and Nike and JP Morgan are wave one and wave two. And when these stocks, if they get going, I've got plenty of insurance and covered call allocation if they don't. If these stocks get going, it's going to be it's Disney, it's Amazon, it's Starbucks, it's Nike, it's JP Morgan. It's not popular to say that at important lows. I think if we look at Starbucks, if we look at Nike, we're already kind of getting these impulse looks from the lows in the, let's call it the blue chip consumer disco sector. Wave one, wave two, right? It was crazy to say, but between 61.8 and 78.6% retracement, that Starbucks could end an important wave two. Now, this is important to understand that the institutions bought lots and lots and lots of straddles on Starbucks right here. And so then what happened? Starbucks falls, right? So what do they get to do? Well, while retail stops out and gets called bag holders, they buy lots of straddles and strangles, right? And so then as Starbucks falls, they get these puts that are, nicely in the money. They're deeper and deeper and deeper in the money. And the deeper in the money they get, the more shares of Starbucks they can buy. Then they start, buying straddles and strangles again towards the low and, doing the same thing to the upside. So that's a little, abstract, but basically what we've seen the institutions do for a lot of these, they bought lots of straddles up here. The stock falls. They buy shares against the puts based on the delta equivalency. So if the put delta, from a strangle went from negative 35 and positive 35, negative 35 for the put, positive 35 for the call. And then Starbucks, plummets to where the put, is deep in the money. It's got a delta of, negative 90, right? The institutions can buy 90 shares of Starbucks against that put because that put could be exercised. If Starbucks keeps falling, then the put becomes stronger and stronger while only 90 shares are bought. So it's still a net bearish position. If Starbucks recovers, then the gamma kicks back in. The put becomes weaker and weaker. But the shares, the 90 shares are still owned. And so it becomes a net long position. And in both those situations, the dividend for Starbucks is collected without risk. I know that sounds bizarre, but I would say the most important thing that can be done for me, just to be frank, the most important thing that I do is I look at this every day. You can see you can see them buying straddles and strangles all the way up, right? You can see what they're doing. I hope, let's see. Okay, SoFi is a great example. So SoFi, I think it was near 5 recently, but SoFi, they buy these straddles on, SoFi, on Palantir, on XYZ stock as it falls. They're buying a straddle at 10, they're buying a straddle at 9, they're buying a straddle at 8, they're buying a straddle at 7, and they're buying against these in-the-money puts while retail stops out. Then if a hypothetical person is watching the bar chart straddle and strangle screener, they can start to see where they start to flip the kind of switch. And instead of buying straddles on the way down, like they did for Starbucks when it was at a much higher level, they start buying straddles and strangles on the way up. So what that allows them to do is keep their shares, which is very beneficial for especially dividend payers, but also even for growth stocks for tax purposes. They can hold the shares longer, and they can kind of hedge the unrealized gains without selling the shares. That allows them to collect dividends. It also allows them to, when they do eventually sell, do it in a more tax beneficial rate. Here is Microsoft. I think it's a large wave 1 and a wave 2. Big old wave 3. An ABC correction that ends wave 4. I think that was right at the 61.8% retracement. So 213.43 is going to be a somewhat tight level to say. If we just call it 213, Microsoft has already ended an important wave 4 correction. It's going to begin an impulse beyond all-time highs. A little wider for kind of a longer term perspective. I think this wave 1 high of 190.70 is pretty useful. This is another one where we haven't broken above this wave 1 high yet. And I say yet, kind of cautiously. We haven't broken above this wave 1 high yet for Microsoft or for SPY. But we're starting to see, I don't think AMD's done it either. We can check. But the bottom line is that if I'm a super short-term Elliott wave bear, I'm not sure I would bet against SPY and Microsoft not breaking the same wave 1, wave 2, wave 3, wave 1, wave 2, wave 3 pattern that we've seen Nvidia kind of suggest is going on, that we've seen a lot of, stocks, even like Nike, even like JP Morgan, even like Starbucks, but, especially for tech, Nvidia's already done wave 1, wave 2, wave 3. SPY, is very close to doing wave 1, wave 2, wave 3. I'm not sure I would bet that Microsoft isn't going to do wave 1, wave 2, wave 3. But, I am prepared for the super crash. Again, Microsoft is a large holding of the Metaverse ETF METV. I currently have the 11 put, the 10 put, and the 9 put expiring for August, just as part of the positions that I've been posting about. And Microsoft is a big holding of that ETF. So that's Mr. Softy. Above 215 is a little, sorry, above 213 is a wee bit tight. 190 is a wee bit wide. The length of wave 3 placed at the wave 4 low says while SPY goes to 600, if SPY goes to 600, Microsoft would be heading into the low 400s. That kind of perfect target is 430. Here is Google. I think that in the big picture, it's kind of like Nvidia and Amazon, where from the 2018 low we get 1, 2, 3, 4, 5 waves, an ABC correction at the 61.8% retracement. So similar to Microsoft above this wave 1 high of 76.61. Nice risk reward for Google is another one where they're going to say from this low, wave 1, wave 2, wave 3 has formed. Has Google broken it? Google has not broken it yet. It's another one in that same uber short-term camp where the dopamine bears may not want to bet that SPY, Google, and Microsoft won't break this small wave 1 high that Nvidia has already broken. The naysayers, the critics, they're going to clown me for this ABC correction because I said this was wave A and wave B, and wave C is a lot longer than wave A. It's actually probably past the 161.8% extension of wave A. The other option would be to say that this is wave A and this is wave B. And so the textbook, by the book, so to speak, would be to say the length of wave A placed at the wave B high has not yet been reached. And so that's what the bears are going to say is their reasoning for calling for another marginal new low in Google. The other option would be to say this is an ABC correction, and then wave C was just shorter than the length of wave A placed at the wave B high. I just wanted to address what the naysayers are going to say. I think it's extremely important to be skeptical. I tried to make a lot of my page and certainly all of my investments based on as little speculation as possible. I know that sounds crazy when I'm someone talking about SPY going into the 600s, Nvidia and Tesla and Bitcoin making new all-time highs and stuff like that. But the only reason that I can actually position myself for those events is because I have these straddles and these strangles, this heavy allocation to covered call ETFs, so that I am always prepared to start running the other way. Kind of like when there's an interception in football, you don't really want to plan for the quarterback to throw an interception, but you don't want to not be prepared for it either. Oh my gosh, what in the world is going on with my Verizon chart? So those freaking wonderful people at Bar Chart, who I love, they did this update. They do these updates and then they mess up my charts and I just complain about it. I don't do anything about it, so I guess that makes me a pacifist. Verizon, large wave 1 and an ABC correction wave 2, another large wave 1 and another ABC correction wave 2. I am in Verizon for the long haul. I updated my AT&T options on my Twitter page recently, but I'm holding Verizon till, I know it sounds ridiculous, until the pitchfork median that's found by connecting the beginning of this wave 1 with this wave 1 high and this wave 2 low is reached for a long-term wave 3 target. It would be this bold black wave 3, just FYI. And I think from this low, this is another wave 1 and another wave 2. We can see a large wave 3 of wave 3 entered. Sorry. Here is Cloudflare. Cloudflare. Okay, so look at what these pesky MMs are doing. You guys don't believe that they're buying straddles and strangles. I can show you they're buying straddles and strangles. Look at this. Don't tell me. Cloudflare, you better still be on this. Cloudflare was on this like 5 minutes ago. So for the bar chart straddle and strangle screener, my official kind of MO is to take note of what's on it at the end of the day. And that's because we sometimes get different readings, when there's an hour left in the trading day, 2 hours left in the trading day. But I'll just tell you guys anecdotally, I saw Cloudflare on the screener when it was at the current price that it is now. The MMs were doing something very, cheeky, as they would say in soccer. They weren't buying a straddle at the $50 strike price. In other words, Cloudflare was at 50, right? So if they're going to buy, if the general idea when buying a straddle is if it's a $50 call and a $50 put. Not for those sneaky MMs. What they did today was they bought the 55 put and the 55 call. So they bought a put that was $4 or $5 in the money, and they bought a call that was $4 or $5 out of the money for a position on Cloudflare. Now, why would they do that? Why would they buy a put that's $4 or $5 in the money and pair it with a call that's $4 or $5 out of the money, $4 or $5 out of the money? Well, there's a few options. One is that they're taking a speculative short position, right? So they bought a put that was deep in the money. They hedged it with a call that was out of the money. And so if they're wrong about shorting Cloudflare, the call is going to save their ass, right? That's not what they're doing. Come on now. Why are they buying a 55 strike put and a 55 strike call on a stock that's at $50? Well, I can't tell this to my broker, but after watching these sneaky MMs for a little bit, I think what they're doing is they're taking advantage of that massive put delta that's going to be for that 55 strike put. I forgot what the expiration date is. Let's assume it was for March, that March 17th, 2023 expiration. They buy the 55 put and the 55 call. So the call has a very kind of weak, delta, but it's going to increase rapidly if Cloudflare recovers. The put, on the other hand, has a very high delta. It's got, probably a -75, -80 delta just right off the bat. And so they're buying that deep in the money put with that big delta because they're not taking a speculative short position. They're not even really taking a speculative straddle position. They're using the straddle vehicle so that they already have that huge negative put delta so they can buy shares against it. At least that's what I think is happening. Certainly can't tell that to my broker. They think I was cuckoo for that. But above 32.70, I think this is a large wave one, subdivided into 1, 2, 3, 4, 5 waves. This is an ABC correction of the 78.6% fib, and we can see Cloudflare begin a large wave three. Let's see, that was the low, I believe, so far. 37.37, 37.56. So for Cloudflare, above that small degree wave 2 low of about 32.70, I think that we're going to see this is a large wave 2 low that's been put in. I should have checked that low before I made the video, but oh well. I think this is an ABC correction that's into this big wave 2 low. That means this is a large wave 1 from the IPO low. This is a wave 2 above 32.70. Cloudflare can begin a wave 3 of wave 3 and be one of those software stocks that, makes those goofy wave 3 runs that seem ridiculous until they happen. If we look at a large cap ETF of the software sector, and I think Microsoft is basically a large cap ETF, the software sector, probably so is Google. We have IGV, software ETF for North America, 1, 2, 3, 4, 5 waves up, I believe, from the 2018 low, just like Google, just like Amazon, a little similar to Microsoft, 1, 2, 3, 4, 5 waves up for a big wave 1. This dramatic ABC correction where the length of wave A, place of the wave B high, is where wave C ends at the 61.8 to 78.6% fib. I like 221. It's getting a little far. 235 is, pick the low, but above 221 to 235, this is a nice gauge of what could happen for the software, stocks as a sector, because we have seen, kind of lows been given up for Palantir, lows been given up for Roku. So when the more volatile names don't have really useful levels, I sometimes look at the ETFs, and I usually just look at the ETFs anyway, because stocks are generally going to move with their sector. Here is Shopify. Shopify is another one where we can see that they are using, straddles and strangles to accumulate. Shopify, what I suspect is going to happen, if you don't believe me, start watching the bar chart straddle and strangle screener. I suspect that as Shopify rallies, we're going to keep seeing them buy straddles and strangles at higher and higher strike prices Why would they do that? There's a few reasons they might do that. Let's just, you know, I basically said this exact same thing with Starbucks, but if they buy straddles up here, and then Shopify falls, they can buy shares of Shopify against the in the money puts. And then let's say they buy a lot of these in late 2022, right? And then they start buying straddles and strangles on the way up. As Shopify rises, then a year and a half from now, if Shopify is in the 200 level and they sell for fat gains, well, then they're going to sell for fat gains at a much more beneficial tax rate than, with a shorter term hold. So it's just the general idea I was trying to introduce in this video, that one reason we might see MMs buying straddles and strangles on the way up is so they can hedge their unrealized gains without realizing them for the tax benefit, for the dividend benefit as well. Here is Bank of America. I've been blue in the face about JP Morgan. I mean, there's about probably a lot of different financials I could do this same chart with, but BAC, more liquid, 1, 2, 3, 4, 5 waves up, large wave 1, and ABC correction wave 2 at the 61.8% retracement. I think 24.83 is getting pretty wide. The higher that BAC gets, the less useful that level is going to be. But I do think this is a wave 1 and wave 2. It's another one where the bulls are going to say a wave 1 and wave 2 is forming from this low. A wave 3 of wave 3 has begun. So that would take, if this is wave 1 and wave 2, the length of wave 1 placed at the wave 2 low could take BAC up to that big round number of 60 for a wave 3 target. Here is Altria. Altria, man. I mean, people still don't believe that, like, computer algorithms are running the show, right? And so I know like, we all know that computer algos are running the show. Everyone says it 24/7. Oh, the algos are screwing retail, right? And so what I think is, if everyone knows that computer algorithms are running the show, why do we get on the edge of our seat every time there's a monthly Fed meeting? Every time, I get an earnings report, right? No one's going to believe that what's said in an earnings report was known about in advance. But, we get on the edge of our seat every time Jerome Powell talks, every time, Jerome Powell sneezes, every time, Elon Musk, sneezes. And I'm just thinking, that's such a waste of time. And we can see why that's a waste of time, when it's just so obvious that this is a computer game. This is a computer game. So they're telling you guys these fundamental stories. They're telling people. Think about the people who don't know about the stock market. Not like the people who don't know about the stock market, because that sounds arrogant. Technically, I'm a retail investor. I don't know anything about the stock market. But if we really think about the people who don't know anything about the stock market, they just go to work, right? What do they think is moving stock prices, right? Medical developments, geopolitical developments, wars, Fed decisions that no one could know about in advance. All these stories, all these narratives, everyone can explain why PFE stock goes up. Everyone can explain why XLE goes up. They never talk about options and, low implied volatility and high volume and open interest and, cheap gamma being bought. And, the point is, everyone who, like, watches the stock market, they can tell you exactly why XLE went up. They can tell you exactly why PFE goes up. And pretty soon, if SPY is in the 500s and the 600s, they're going to be able to tell you why that happened as well, right? But that's going to be bullshit, right? And we can see right now why that's going to be bullshit, because this is a computer game, right? This is literally... Do you think that do you think that regular human beings caused this to happen? No. Regular human beings did not wake up on, Tuesday or Monday morning of last week and take crazy speculative positions on half the value sector and cause that. Right? No one actually thinks that, right? So we laugh about that, but then the next time a government threatens you to take a medicine that you don't want to take, the next time that a country's invaded and there's, some BS story, right? 99% of Americans, they're going to nod their head and say, oh, yes, commodity prices went up because this, completely unscripted, unstaged, unplanned war, right? Not because of all the options activity on XLE and Oxy and Chevron, that I pointed out. But it's kind of just sad. You know what I mean? Because it's like, it's just like you see people you care about, you see people you love, and they'll say with a straight face that XLE went up, because of a war in Ukraine, right? And everyone says that. I'm the crazy person for saying that it was because of options activity and that was planned in advance, right? And everyone will say that, PFE and AZN and MRK, that they all went up because of the lemur that had sex with the orangutan who, a Chinese person made out with, right? But they'll never say, nah, this is all just a computer game. Like that didn't cause any of that, right? I think it's sad, right? Maybe I'm wrong. Maybe it's not sad that, most of America lives in this giant illusion world where they talk about, these geopolitical events like they aren't staged, like they aren't scripted, like, we can't see the institutions are buying a crap ton of the 45 strike straddle on Altria so that when Altria goes down, they can buy shares against those in the money puts, collect that fat dividend without risk. And then what, right? We hear a news story about, tobacco regulations. We hear a news story about, pot regulations. And it's like, oh yeah, that's why Altria went up. That's why, this company that made jewels that, killed teenagers, right? That's why it went up. It wasn't because of all the options activity, and I just think it was, you know what I mean? But anyway, that's 1, 2, 3, 4, 5 waves up for Altria. I think in the big picture, that's an ABC correction. So this is a wave 1 and a wave 2 from an important low, above 36.54. That's 78.6% fib. We can see a large wave 3 entered for Mo. Here is AAL, American Airlines. I think this is a 1, 2, 3, 4, 5 waves impulse on the big picture. An ABC correction that ends a wave 2. And then this is another wave 1 and another wave 2 at the 78.6% fib. We can see American Airlines begin a large wave 3 of wave 3. This is going to be another one where, the pick the low level is 11.65. Not a bad risk reward level. I think that most people are going to see this 78.6% extension and say, American Airlines going into the 30s is crazy. Just kind of like they say that Boeing going into the 300s is crazy. And Royal Caribbean, putting in a major low in transportation is crazy. I don't think it's crazy. That's actually my bias, but I support skepticism. I support being prepared for recessions. I support having a plan B. I think one of the things that me and the Bears agree with is I hate permabulls too. I hate permabulls. I hate permabulls more than the Bears. And I think that's going to be surprising to a lot of people, but permabulls are the problem with our society because they have all their money in the stock market, in a Roth 401k, and an IRA, right? And so then they're just long the market. And so when the government, and when the, I guess I should say the shadow governments, right? When they plan these, events, right? They plan these crashes. They plan these, oh no, like the war in Ukraine's causing inflation. That's why the market's down. That's why we need to send all this money to Ukraine. And if you don't support it, well, then, we're going to crash your 401k. Or, oh no, the market's going down because of a virus. And, if you don't get this, job, then, you're going to be fired and, we're going to crash the 401k. So they're just coercing you. Oh no, The banks and the whatever, the banks are crashing. The banks, those freaking idiots at Lehman Brothers, man, they just were so irresponsible. Oh no, if we don't bail out the banks, your 401k is gonna be gone. So they use the 401k, they use the Roth, they use the S&P to threaten you, to put a freaking gun to your head and say, hey, you don't want this jab, you don't want this job, you don't want this bank bailout, you don't want this money sent to Ukraine. Well, too bad, because you got all your money in the Standard & Poor's 500. And until we get all the middle class to nod their heads and agree that they want what we've already decided they're going to accept, then hey, they literally have you, in the words of George Carlin, by the balls. So I hate permabulls because they don't have me by the balls. They could crash this bitch right now. I don't give a fuck. I have deep in the money puts on the Metaverse ETF. I have a 60% allocation to buy right ETFs. I buy boring, value stocks, with larger positions than what I have in growth, right? So they can't coerce me, right? They can't threaten me, right? But they can threaten people who have much bigger net worths than me because all their money's in the S&P, right? They don't have even people in their people are 65 years old, 70 years old, all their money in the S&P. Let's go, baby, right? But I'm the permabull. I'm like, oh my gosh, man. Anyway, this is Nike, large wave 1, ABC correction wave 2. We got 179.10. I'm going to take these fibs. Same song, second verse, large wave 1, wave 2 with a 78.6% retracement. The dopamine bulls, the dopamine bears, they're going to say this daily wave 2 low of 101 is going to hold. Not bad risk reward. And we've entered a wave 3 of wave 3, a large degree wave 3 on the weekly chart, and also a small wave 3 on the daily chart. That could take Nike in the big picture up to 200. So that's Nike. Here is Target, another consumer name. I posted recently about how there's a few ways to, view Target. The more conservative way, and I think this is actually the incorrect way, is that this is a wave 1 and wave 2. This is a big wave 3 that makes a new high on the weekly RSI and an ABC wave 4 correction. So the bulls are the bare minimum going to look for a new marginal wave high for wave 5. And then the bears would say that's, crash time after that. I don't think that's accurate. It's not just because of Nike and Starbucks and, other consumer, related stocks. I even think just looking at Target, that this is another wave 1 and another wave 2, primarily because there is this idea of wave personality in Elliott Wave. It's a little more abstract than, the rules, but the general idea is that wave 2 is dramatic. Wave 2 is this big swinging A, B, C. You can almost see it like, from a mile away. It's real dramatic, real, right? Wave 4 is typically more sideways. It's typically more of the boring bull flag, the, downward sloping parallel channel where, they don't really scare retail out as much as they wear retail out. This looks like the scare you out wave 2. And a little more mathematical base than that is that it ended at a 61.8% retracement. So wave 4 can end at the 61.8% retracement. As a general rule of thumb, if a stock's a lower beta stock, I'm looking for wave 2 to be between the 50 and 78.6% retracement, and a wave 4 to end above the 50% retracement. For a higher beta stock, something like a growth stock, wave 2s can go deeper than the 78.6% retracement, certainly, but even wave 4s can be a little deep. A wave 4 could be, let's just say this, if this was a very, very high beta growth stock, I would be a lot more inclined to call this, a wave 4 correction than a wave 3, just because generally, if there is a deep wave 4, it's going to be on a high beta growth stock. For Target, sometimes the more stable names, I'm looking for a 61.8% retracement correction. That's a wave 2. anyway, I hope I didn't confuse the crap out of anyone. But this is one of those scenarios where if I was, turning in my homework to the wave professor, and it was wave one, wave two, wave one, wave two, wave three being expected, or 1, 2, 3, 4, 5 waves being expected, both answers would be correct in my opinion. Both would say that there's, very nice RR for targets above 137. I think I had 133 as a little wider level, but I'm not quite sure where I got that from. So we'll go with 137 for now. I think I had 133. I don't know where 133 was. But anyway, above 137, hard to argue. Great RR for target. Nice little dividend for target as well in the dividend growth sector. Let's just touch on that for a little bit. So if we look at target's dividend, I think one thing I've been thinking about recently, and this is maybe getting into the abstract world, is that if we look at, a stock like Johnson & Johnson, a stock like Starbucks, a stock like Pepsi, a stock like, really some of those big, Walmart, maybe those big, dividend growth names that are blue chips that did really well, part of me in hindsight, I must have such mental, what's it called, muscle memory, where I just always click on the interactive chart. I'm trying to click on the fundamentals right here. There we go. So part of me has been thinking recently, with regards to stocks like PepsiCo, stocks like Walmart, stocks like Starbucks, stocks like Johnson & Johnson, they have great charts, but there was another way to kind of see how their success would be, foreshadowed in advance by their fundamentals. Now, this is, I'm the Elliott Wave, options guy. So anytime I talk about fundamentals, it really throws a lot of people off. But if we look at this right here, what I'm basically saying is that Starbucks had a growing dividend. Target had a growing dividend for a while. It had a very high dividend payout ratio. And what I'm saying is that if I'm speculating on the stock price, right, that's Elliott Wave theory, that's options. But I think another way that I would like to be analyzing stock prices in the future is by speculating on the dividend, right? Speculating on the dividend growing, because there appears to be a high correlation and causation with the dividend growing and it being sustainable. So what's the general rule of thumb to say something is a dividend trap versus something is not a dividend trap? So for those who aren't aware, a dividend trap is kind of the name for a stock that pays a really high dividend, but it does it with a lot of its funds, and so it's not really sustainable. So the dividend payout ratio is generally the go-to metric to determine if one, of a dividend's sustainable, but two, if a dividend's growth is sustainable. The general, super general, and this probably varies by sector, rule of thumb is that above 20%, it's sustainable, below 20%, it's not. What I'm getting at is that if I'm speculating on stock, in the future, what I want to do now is if it's a dividend stock, I don't want to just be speculating on the stock's price. I want to be speculating on the stock's dividend and the sustainability of that growing dividend, because I've been looking at a lot of these charts. For example, let's just look at a different one, PepsiCo, right? We look at the PepsiCo chart. Is there a really, clear wave count here? There probably is, right? There probably is. But if I look at the PepsiCo chart and I look at the Johnson & Johnson chart, is there a super clear wave count here? Maybe, right? Maybe not. But if I look at what was the more useful way to really predict that these stocks were going to do well, it'd be something like this, where we see PepsiCo has a 66% payout ratio, and it had been growing its dividend for, since the 80s. So the general idea is that while someone could have done Elliott Wave, someone could have done options analysis to predict that Pepsi was going to do really well, that Johnson & Johnson was going to do really well, they also could have speculated on the dividend growing, and the dividend growing sustainably. And as the dividend grew and it was continued to be raised, the payout ratio was super high, and it basically, what I'm trying to get at is that an investor was rewarded on these names for speculating that the dividend was going to grow and be sustained. And I think it's kind of a third, you know, metric that I'm going to add in my analysis, along with options analysis, analyzing the options market, seeing what the MMs are buying straddles on, what stocks they could be buying a straddle on, and then, buying shares against on a future dip, stuff like that. But also, Elliott Wave would be obviously the second metric. And then I think the third metric is going to be speculating on the dividends growth in the future and the dividends sustainability based on the payout ratio. Anyway, that's just something that I'm trying to introduce. Here is First Majestic Silver. Some stocks that I bought recently based on that logic. I would say US Bank, Verizon, Starbucks, certainly, obvious picks for that. Anyway, here is First Majestic Silver. I think this is a wave one and a wave two. I think this is another wave one and another wave two at the 78.6% fib. I'm in First Majestic Silver forever from 10 point something, 10.60. So I'm a bag holder, technically. But I think this is what I'm really planning is that this is a wave one and a wave two, and this massive black wave three will end at the median of this long-term pitchfork. I know that sounds goofy, right? That's a moon boy target. I get it. I think from this low, this is another wave one and an ABC wave two at the 78.6% fib. We can see AG enter a large wave three. I don't really think there's too useful of levels for First Majestic. I'm going to be using position size, kind of the fundamental backing of commodities. I know that's saying fundamental backing on a YouTube video about stocks is, guru side, so to speak. But part of my investing mentality is that everything is correlated with something, and commodities and precious metals and energies and soft commodities, they are inversely correlated with the purchasing power of my cash, right? So I'm getting all this premium coming in from dividends and covered call ETFs, and I want to make sure that cash that's coming in still is maintaining its value. And the best way that I can do that is by investing in commodities, by investing in crypto with the proper position size based on the higher beta of these asset classes. Anyway, that's gonna, for most people, they're just gonna say, oh, he's fundamentally whatever commodities and crypto. There is nuance to a lot of things, and I'm building a portfolio, so I've got a lot of cash coming in from covered call ETFs, from dividends. I want to make sure that cash has the buying power that it needs to, and the primary way that I can do that is investing in commodities related names. Here's a wave one and a wave two for silver. I think this is another wave one and another wave two, a really kind of important level. Obviously it's an important level, but above 16.66, the bulls are going to say SLV ended an important wave two correction, and it's already within a wave three of wave three. I haven't checked, and I think in the big picture, by the way, that silver SLV can go all the way to the median of this pitchfork as well. In the big picture, I know saying SLV can go into the 50s, right? That's crazy, right? Everything's crazy, and then once that wave one high breaks, then it's not so crazy anymore. Did Alamos Gold? I haven't even checked. We did. Oh my god. Okay, if you're a precious metal bull who's just me, because this is just to document what I'm doing, I'm a precious metal bull. Oh baby, don't tell anyone, but we just got Alamos Gold above this wave one high. In my opinion, that gives confirmation from an Elliott Wave perspective that this is a wave one and this is a wave two for a gold miner. And a wave three of wave three has begun. So I think this is wave one and wave two. In the big picture, this black wave three, I suspect will end at the median of this pitchfork. The way it's going to get there, in my opinion, is that this is a wave one and a wave two, and it's very wide right now. That's honestly not even useful at all. But 6.35 is going to invalidate that a wave two has already ended. But from an evidence standpoint, it's not an opportunity. But from an evidence standpoint, this stock AGI breaking above 11.58 has given what Elliott wave theorists have as confirmation, kind of like Caterpillar making a new all-time high, that a wave 3's begun. This is wave 1 and wave 2. We can see this impulse begin. It may be a huge leading indicator for other precious metal related names, particularly in the gold sector, but I think also silver as well, that we could see some of those late to mid 2020 highs broken across the metal sector. Here is IEO. I think I was gonna do uranium fuels with this, so we might do UU next. But IEO in oil, I think from this low, first off, and what are the bears going to say? The bears are going to say that this whole cycle is going to be corrected. So it's very difficult to see with how I have this marked up right now. But the bears are going to say this is 1, 2, 3, 4, 5 waves up. Oil is going to correct this whole cycle. Not something I'm laughing at. That's definitely not something that I'm laughing at. And I have the 12 strike straddle on ET, where the 13 call is pretty in the money, and that expires in April. And I have the 12 call and the 10 put strangle on ET that expires in 2024. Both of those call legs are about $1 in the money. But if we did see oil crash, there are put legs that still have a little bit of life. I'm not planning on there being a crash in oil. I think that this is a wave 1 and a wave 2. I believe this is another wave 1 and another wave 2 at the 61.8% retracement. This is IEO. I just think it's got a pretty, I saw this on an option screener, I'll be honest, but I think it's got a very pretty view of what the bull case is going to be for oil. The wide invalidation for the daily chart is 77.53. The bulls are going to say that this is a wave 1 and a wave 2. This is another wave 1 and another wave 2 at the 61.8 to 78.6% retracement. 83.70 is a little tighter than 77.53. This is wave 1 and wave 2. A big wave 3 of wave 3 can begin. The next target is 115 before a shallow wave 4 and a wave 5 higher. If wave 5 is the length of wave 1, place at the wave 4 low, and wave 4 retest the wave 1 high, we could see IEO go all the way up into the 130s. I think off the top of my head, that's about a 25% gain from the current level. Here is Tesla. I think I talked about a good amount of growth in this video, but 1, 2, 3, 4, 5 waves up. Wave 1, ABC correction. Wave 2, between the 61.8 and 78.6% retracement. And the bulls are going to say, a big wave 2 ended at 101. Now, I'm managing my downside risk in, Tesla, but also growth with position size, straddles and strangles on growth ETFs, particularly METV, in time, waiting, having a time horizon for these to play out that is quite large. But I'm not going to stop out if Tesla goes below 101. It's not even really that useful of a level. But 1, 2, 3, 4, 5, wave 1, ABC, wave 2. The bulls are going to say this big old black wave 3 is in the early stages, and bears are going to call it, the Enron Musk scam bubble. Until then, we should probably get a few Elon tweets that are very outrageous before we get to a new all-time high. Definitely before I talk about levels beyond a new all-time high. Here is Bitcoin. 1, 2, 3. Oh, is that another growth name that's putting a little low? Anyway, or even calling someone a low. You don't even feel like you can do that. But we have had these growth stocks make a little bit of noise. We've seen China make a little bit of noise. We've seen crypto make a little bit of noise. We could see Tesla make a little noise. You notice how they all have their own special reasons, right? None of the reasons are just because they're all in the same, growth ETFs, the same growth sector. The birds of a feather are going to flock together. The ARK stocks are going to move up together. Shopify and Tesla and Ethereum and, Roku are probably over time going to move together. No one, says that there's a special reason Bitcoin goes up. There's a special reason China goes up. There's a special reason Tesla goes up. And then one day it's Bitcoin, one day it's Tesla, one day it's Shopify, one day it's Roku, one day it's Netflix, one day it's Facebook, and then all of a sudden we have a big rally in growth, and each day the individual stocks had an outperformer that had a special reason, right? The show goes on. 1, 2, 3, 4, 5 waves up for Bitcoin wave 1, ABC correction wave 2, 14,881 useful level. I'm gonna keep holding my BITO and my Litecoin that I'm bag holding. I'm not bag holding BITO, but I am bag holding Litecoin from a probably pretty damn high number. I think the 220s. But then I got into BITO around 10.60, so I don't even know if I'm bag holding crypto. Don't really care. I have straddles on the Metaverse ETF, kind of to indirectly, hedge downside in crypto. I will also say that kind of similar to commodities, I view crypto as something where I'm getting this premium coming in. I'm getting these dividends coming in. I want to make sure that cash actually maintains its value. Anyway, that's called upside risk, and most people don't get it until there's an all-time high being made. Then people are telling me why Bitcoin's going up. Once people are telling me why Bitcoin's going up, that's anyway. 1, 2, 3, 4, 5 waves up for Ethereum in ABC correction. Wave 2 at the 78.6% fib, right where the length of wave A placed the wave B high is where wave C ends. The bulls are going to say from this low, Ethereum has formed a wave 1 and a wave 2, abstractly similar to what I've talked about with, tech and, where it's a wave 1 and a wave 2. I don't know how many names we've seen. Honestly, Ethereum is probably the only one where we have this nice little wave 1, a wave 2 that didn't break the wave 1 low. And so the next confirmation level is going to be we're going to break above 2028, confirm this is a wave 3 from the low, which will further confirm this isn't just the wave 3 on the daily chart. It also could be a 1, 2, 3, 4, 5, wave 1, wave 2, wave 3 on the weekly chart. 883, not a useful stop, useful and validation. 1077, useful, level from a risk reward standpoint. But right now, I think the biggest kind of risk is to the upside. I really do. Wave 1, wave 2. I would not want to be one of those people all in the S&P, no crypto allocation, no metals allocation, and seeing silver in the 50s, Ethereum in the 5,000, 6,000s, because that's when people get scared, and that's when they can say things like fiat risk and the dollar is going to collapse and stuff, and then all the people who ignore silver and ignore crypto during the drops, they kind of get scared into buying it during the rally. But anyway, that's Economics 101. Here is Ripple. I am in the Ripple cult. I should probably stop saying that. But man, I don't know, man. Something about it. Something about this, little coin. It's okay to have 1 or 2 cult stocks, I think. But this isn't just a cult stock. It's also a wave count. Wave 1, wave 2. I think this is another wave 1 and an ABC wave 2. When I look at this chart, the first thing I think is who wants to be a millionaire? It's probably a bad thing to think, but this has always been one where I was like, I'm not sure that crypto rally's done. I'm not sure that this is the end of crypto. I'm looking for, in the big picture, as I have been, to be fair, for a while, that Ripple's going to go break this all-time wave 1 high in a similar fashion that Bitcoin, Ethereum, and Litecoin did after 2020.